What if just 3 simple ETFs could turn your modest investments into serious life-changing wealth by the time you retire? In 2026, with markets poised for massive growth, I'm revealing the ultimate lazy portfolio that's outperformed complicated strategies for decades, and it could make you very wealthy without picking a single stock. Stick around to the end, because this combo has historically delivered double-digit returns, and it's easier than you think. Tired of ETF overload? Let's build your future, one portfolio at a time. Cut to host in a clean, modern studio with charts and ETF tickers subtly in the background. Hey everyone, welcome back to the channel. If you've ever found yourself deep in a late-night Google rabbit hole searching for the best ETF, or endlessly scrolling through social media threads full of hot stock picks and cryptic chart analyses, wondering if any of it is actually trustworthy, trust me, you're in good company. As of December 2025, with the market hitting new highs amid AI hype and lingering inflation worries, it's easier than ever to feel overwhelmed. Everyone seems to have an opinion on the next big thing. But here's the truth. Almost no one, beginner or pro, truly knows what they're looking for in isolation. The real game changer isn't hunting for a single best ETF. It's aligning your investments with the life you envision 10, 20, or even 30 years down the road. Do you crave steady monthly income to cover rising bills without touching your principal? Or are you betting on explosive growth to fund that dream retirement or legacy for your kids? Maybe a mix of both, something reliable yet rewarding. Today, we're cutting through the noise together. I'm breaking down 3 straightforward ETF portfolios, each engineered for a distinct future, one laser-focused on income generation, another on balanced progress, and the third on maximum wealth multiplication. We'll explore how they work under the hood, who they're ideal for, and, backed by real data and projections, the outcomes you could realistically expect. We'll even crunch the numbers on a portfolio that could deliver over $10,000 in monthly dividends, and one that transforms a modest $10 daily investment into north of $3 million over 3 decades. But before we jump into the specifics, let's ground ourselves in the investing landscape as it stands right now, on December 15, 2025. It's a peculiar cocktail of opportunity and uncertainty, and understanding it will make everything else click. Start with the squeeze on everyday wallets. Inflation isn't the roaring beast it was in 2022, but it's still nibbling away. According to the latest Bureau of Labor Statistics, BLS data released on October 24, 2025, the Consumer Price Index, CPI, for all urban consumers rose 0.3% in September alone, pushing the 12-month rate to 3.0%, the highest since January 2025. Food prices, a pain point for so many families, climbed 3.1% over the same period, with meats, poultry, fish, and eggs up a steeper 5.6%, non-alcoholic beverages at 4.6%, and fruits and vegetables edging 1.9% higher. That doesn't sound earth-shattering in a single year, but compounded over a decade, and a $500 monthly grocery bill balloons to over $670, all while wages haven't kept pace for many in the gig economy or mid-career plateaus. Zoom out to the stock market and it's a different story, exhilarating yet exhausting. The S&P 500, that bellwether of U.S. equities, has delivered an average annual return of about 10.3% since 1928, including dividends. Enough to turn $1,000 invested back then into over $1 million today, adjusted for inflation. But the ride, brutal at times. Historical data from sources like Macro Trends and NYU Stern's Aswath Damodaran paint a vivid picture of volatility. The 1930s, scarred by the Great Depression, saw the index plummet 43.3% in 1931 alone, followed by a staggering 54% rebound in 1933, a reminder that markets don't march in straight lines. Fast forward. The 1974 oil crisis and stagflation crushed returns by 26.5%, while 2008's financial meltdown shaved off 37%. More recently, 2022's inflation-fueled bear market dropped the S&P by 18.1%, only for 2023 to roar back 26.3%, and 2024 to add another 24.8%. As of mid-December 2025, the index is up about 22% year-to-date, driven by tech giants like Nvidia and Microsoft amid the AI boom. Yet, even in this bull, intra-year drawdowns hit 10 to 15%, testing nerves. What ties these eras together? Cycles. Growth phases breed excitement and overvaluation, leading to pullbacks that feel like apocalypses, followed by recoveries that reward the patient. The 1930s averaged just 0.1% annually, but included that wild 54% spike. The 1950s delivered 19.4% average returns amid post-war boom. The 2000s lost decade, a mere 0.9% yearly, hammered by dot-com and housing bubbles. Lesson: volatility is the price of admission, but time in the market trumps timing it. This backdrop explains why structured strategies matter. Think of your portfolio as a vehicle powered by three interconnected engines. 1. The income engine generates reliable cash flow to weather storms without liquidating assets at lows. Crucial when inflation erodes purchasing power. Think of it as your portfolio's paycheck. 2. The stability engine dampens shocks through diversification and defensive holdings, preventing emotional whiplash during 20-30% drawdowns, which occur roughly every 5 to 7 years historically. 3. The growth engine accelerates wealth via compounding in high-potential sectors, outrunning inflation's 2.3% annual creep and building that multi-million-dollar nest egg. No portfolio runs on one engine alone. It's about tuning them to your risk tolerance, timeline, and goals. Retirees might crank up income and stability, a 30-something saver, full throttle on growth. Enter ETFs, the Swiss Army knife of modern investing. Launched in the 1990s, they've exploded to over $10 trillion in assets globally by 2025, per ETF GI data. Why? Simplicity. An ETF bundles hundreds or thousands of stocks or bonds into one tradable share, delivering instant diversification at rock-bottom costs, average expense ratio under 0.2%. Forget agonizing over individual picks like Tesla or Procter & Gamble. Buy the Vanguard S&P 500 ETF, VOO, and you own 500 blue chips for $4 a year per $10,000 invested. Take risk, $1,000 in a single tech stock like Meta. A 40% drop, as in 2022, leaves you with $600. In a tech ETF like VGT, the same hit across 300-plus holdings might trim just 5-10%, recoverable via the winners. Returns break down predictably, 2 to 3% from current dividend yield, 4 to 6% from dividend growth, as companies like Apple hike payouts 10% plus yearly, and 5 to 10% from price appreciation as earnings expand. ETFs automate the grunt work too. Quarterly rebalances keep holdings fresh, tax efficiency minimizes drag, more on that later, and liquidity lets you trade like a stock. In 2025, with robo-advisors like Betterment integrating them seamlessly, even hands-off investors can automate contributions via apps. But choosing ETFs? Don't overcomplicate. Use a four-lens framework. Quality. Are the holdings resilient? Look for ETFs with top quartile earnings stability like SCHD's focus on dividend aristocrats, 25-plus years of increases. Growth. Revenue touching profit-taught trends. VGT's tech tilt captures 20% plus CAGR in semiconductors since 2010. Stability beta under 1.0. BND's bonds correlate lowly with stocks, cutting portfolio volatility by 20-30% in models. Income. Yield plus growth. JEPI's 8% plus via covered calls, but check sustainability. Avoid yield traps over 10% without ROC, return of capital warnings. This system demystifies the 8,000 plus ETFs out there. Now let's tackle beginner pitfalls, because even smart folks trip here, costing 1-2% annually in returns, per Vanguard studies. Mistake number 1, chasing hype. In 2025, AI ETFs like bots surged 35% YTD on ChatGPT buzz, luring 2B inflows. But many bought peaks, selling at 2023 somberver, mein seer, Waritz, ein die duidisurs, mein gur, wein berduin, widans en fur, Trusson von duren, ein Tursemburi dan bruren sander bur, mein ver, wang. Solution: ignore TikTok tips, stick to fundamentals. Historical data shows momentum chasers underperform buy and hold by 3 to 5%. Darger 2, panic selling dips, a 10% correction. Routine, S&P has 10 plus such events per decade. Yet Dalbar's 2024 report found average equity investors captured just 5.5% annual returns versus market's 10.2% due to emotional exits. Antidote: set rules like no sales below 20% drawdown. Number 3, no strategy. Random buys lead to drift. Your diversified portfolio morphs into 70% tech after a bull run. Fix: annual reviews, targeting 60-40 stock-bond splits. Number 4, overconcentration. Dumping 50% into ARKK worked in 2020, months 150%, bombed in 2022, months 67%. ETFs mitigate this, even sector ones like XLE, energy cap exposure. Number 5, fees and emotions. That 1% expense ratio eats 25% of 30-year returns. And hourly checks? Behavioral finance calls it attention bias, spiking trades 20% in costs. Number 6, ignoring taxes, dividends. More later, but overlooking qualified dividends, taxed at 0-20%, versus ordinary income, up to 37%, can slash after-tax yields 15%. Spot these, and you're ahead of 80% of retail investors, per Morningstar's 2025 Mind the Gap report. With pitfalls navigated, let's build the income portfolio. Ideal for semi-retirees, dividend enthusiasts, or anyone prioritizing cash flow over fireworks. It cranks the income and stability engines, with growth as a gentle hum. Goal: predictable payouts covering 5K plus monthly expenses, NAV erosion minimal. Core philosophy: covered calls and bonds for yield without wild rides. 3 ETFs, equal weighted, 33% each for simplicity. JEPI, JP Morgan Equity Premium Income ETF, the STAR, launched 2020. Uses S&P 500 stocks, sells out-of-the-money calls for premium income. As of Dex 12, 2025, yield NORD 8.12%, paid monthly, 469 share past year, YTD return 8.22%, 1YR 10.23%, trades upside, beta 0.6 for reliability, 549% historical div growth, 2.12% appreciation, AUM 40.9B, expense 0.35%. In flat markets like 2022, it returned 4.3% versus S&P's 18%. Drawback: caps big rallies, but for income, gold. SCHD, Schwab U.S. Dividend Equity ETF, Dividend Aristocrats backbone, tracks Dow Jones, U.S. Dividend 100, quality firms like Coca-Cola, Home Depot, 25 plus years hikes, yield 3.74%, div growth 10.43%, top decile, appreciation 7.95%, YTD by 1.69%, but 10-wire AVG 11.5%, expense 0.06%, stability king, max drawdown 20% in 2020 versus markets 34%. BND, Vanguard Total Bond Market ETF, the anchor, 10,000 plus U.S. investment grade bonds, yield 3.8%, div growth 3.57%, appreciation 0.85%, rising rates hurt, but 2025's 4% Fed cuts help. Expense 0.03%, reduces equity vol by 15-20%. In 2008, bonds plus 5% as stocks tanked. Portfolio metrics, simple average, yield 5.29%, div growth 6.5%, appreciation 3.07%, total return 8.36%, conservative. Historical backtests via portfolio visualizer show 7-9% over 10-1. Rs. Y equal weight. Balances JEPI's yield punch with SCHD BND's ballast. Rebalance annually or at 5% drift. Use dividends for underweights to minimize taxes. Now projections. 10-day, 3,650 WAR invested. Reinvesting divs, assuming 8.36% total return. Yield plus app plus growth ADJ. Using compound annuity formula. FV 400 PX, 1 PSOR in, 1 RX 1 PSOR, where annual contrib. Year 1, $3,650 invested, $3,800 end value. Year 10, $57,370 as modeled. Dives contribute $20K. Year 20, $237,440, $100K plus from compounding dives. Year 30, $1,237,800, $747,659 from reinvested dives, 48%. $195,963 app, 13%. Rest contribs auto growth. Monthly income, $125,746 wire or $10,470 enough for full mortgage or travel fund. Tax efficient in IRA. Real world tweak. In 2025's 3% inflation, real return, 36%, still beats CDs at 4%. Risk, rising rates could ding BND 5-10%, but JEPI SCHD's equity tilt offsets. Case study. A 55-year-old teacher I know shifted $200K here in 2023. By DEC 2025, $15K annual divs cover her car payment, NAV up 12% despite 2024 dip. No more 401K raids, she says. Taxes? Qualified divs, most here, at 0-20% plus 3.8% NIIT for high earners. Hold 1 plus YR for LTCG on sales. In Roth IRA, tax-free, per IRS 2025 brackets. Singles under $48,350 taxable income pay, 0% on qualified divias LTCG. Rebalancing, threshold-based. If JEPI drifts to 40%, sell 7% to buy BND. Annual cost, 0.1-0.2% via low-turnover ETFs. This portfolio shines for predictability. 95% uptime on divs since inception, vol half S&Ps. If income's your North Star, start here. But scale contribs as earnings grow. You've got the income blueprint, reliable, sleep-easy cash. But what if you want more acceleration without white-knuckling every headline? Enter the balanced portfolio, the Goldilocks choice for mid-career pros or families building legacy. It harmonizes all three engines: solid income stability from core holdings, turbo growth from innovators, and global buffers against US-centric risks. Rationale: pure income lags in bulls, e.g., missed 2023's 26% S&P surge. Pure growth terrifies in bears, 2022's 25% tech wipeout. Balanced captures 80-90% upside with 60-70% less vol per Morningstar backtests. In 2025's choppy waters, AI euphoria meets Fed uncertainty that's by bis ein inberdusterdens annoyance-skånande dörrit desert it's resilient. 3 ETFs, equal weighted. SCHD returns as anchor, 3.74% yield, 10.43% div growth, 7.95% app. Its 100 quality payers, e.g. Verizon up 15% dives 2025 ground volatility, 10-war Sharpe ratio, 0.85 versus S&P 0.7, VGT, Vanguard Information Technology ETF, Growth Spark, 300 plus tech names, Apple, 30% weight, Nvidia, AI Darling, Bloods 150% 2025, yield 0.4%, div growth 10.11%, app 21.82%, YTD plus 28%, 10YR 20.1% annualized, expense 0.10%, captures cloud semiconductors, 2020 COVID pivot, plus 46%, risk, sector concentration, beta 1.2, INTF, iShares International Equity Factor ETF, diversification wildcard, multi-factor, value, momentum, across 1,000 plus non-US stocks, Europe, Japan, emerging, yield 2.67%, div growth 19.36%, factor tilts pay off, app 4.79%, expense 0.30%. Why? US dominance wanes, 2025 EM rebound plus 112% as China stabilizes, reduces home bias, portfolios with 20-30% ENTL outperform domestically heavy by 1-2% long-term per Vanguard, averages, yield 2.29%, div growth 13.3%, app 11.52%, total return, AMR 13.81%, backtest at 12 and 15% over 15 years. Projections, 10-day, year 1, $3,650, $3,900, year 10, $70,821, 25K divs, year 20, $346,384, 120K divs, year 30, $1,463,394, $300,97 divs, 21%, $1,547,96 app, 104% of value. Monthly, $40,073 wire or $4,081. Covers college tuition chunks, edge over income, 429K at 30 wires real return, or 10.81% post 3% inflation, 2025 example, by 18% YTD versus income's 9%. The growth portfolio, all in on the expansion engine, for horizon-focused warriors, 20 plus wires, chasing millionaire status. Volatility, expected. Payoff, exponential. Philosophy, own tomorrow's winners. Tech drove 60% of S&P gains last decade. This amplifies that ethically, ESG tilts in IWF. Historical precedent, 1990s tech boom turned 10K into 100K plus, ETFs, VGT, core, 0.4% yield, 10.11% growth, 21.82% app. Nvidia's 2025 AI chips, pure exposure. QQQ, Invesco, QQQ Trust, NASDAQ 100 Elite, Magnificent 7, MSFT AMZN Dominate. Yield 0.46%, growth 9.45%, app 17.12%. YTD plus 25%, 10 watt odd year 18.5%, expense 0.20%, outperformed S&P 2x since 1999. IWF, iShares Russell 1000 growth, broadens to 400 plus growth stocks, Eli Lilly, healthcare AI, Visa, fintech, yield 0.34%, growth 2.03%, low but quality, app 16.45%, expense 0.19%, less tech heavy, 40% versus VGT's 100%, beta 1.1, averages, yield 0.4%, growth 7.2%, app 18.46%, total SAR 18.86%, historical 17 to 20%, 10-day year 10 weight, 8 halper 1 year 20 halfer 1 right with 574, 6 on 90, year 30, buying 32, 18, 5, 6, 7, 4, 7, 41 div, 0.1%, 3, 4, 3, 26 size app, 98%, monthly, 3, 39 war, irrelevant, sell 4% safe withdrawal, 10K by the moves, others, 260 met over income, 173 overbalanced, real return, 5 dirt dart infaring, 86%, 2025, buzzed 32%, white tag sambai, I3. Comparisons, income safest, sharp 0.7, vol 8%, balanced, Zardstro 9, 12%, growth 1.1, 18%. In 2008 crash, income 15%, balanced 25%, growth 40%, but recoveries, growth 300% by 2018. Taxes 2025, qualified divs, LTCG 0%, 48K single, 15%, 48K 5-weight EK, 20% above, plus 3.8% NIIT, ETF sufficient, low turnover, 5%, cap gains rare. Use Roth for growth, taxable for income, ordinary rates 10-37% on non-qual, harvest losses annually, rebalancing, calendar, yearly low tax or threshold, 5% drift, use contribs, studies Vanguard show plus 0.51% annual boost. Tools, Excel or apps like Empower. Your move, assess risk, questionnaire, can you stomach 30%, growth yes, income no. Start small, automate via 401k, IRA. 2025 tip, dollar cost amid highs, S&P ATH's historically great buys. Want $5 day, 8K MO, like, subscribe. Your future self thanks you. This in-depth YouTube video serves as a beginner-friendly yet data-rich guide to building long-term wealth through ETFs in the current economic climate of December 2025. The core message. Stop chasing the mythical best ETF and instead choose a structured portfolio that aligns with your desired lifestyle 10-30 years ahead, whether that's steady monthly income, balanced growth with lower stress, or maximum wealth multiplication. Market context and mindset foundation. The video opens by acknowledging the overwhelming noise in investing, endless social media tips, hype cycles, and confusion over charts. It grounds viewers in 2025 realities, inflation lingering at more 3%, BLS data, CPI up 3.0%, YOY through September, food plus 3.1%, eroding purchasing power, while the stock market continues its historical pattern of volatility, e.g., S&P 500's wild swings from 37% in 2008 to plus 154% rebounds in 1933. Key insight, markets follow repeatable cycles, growth, excitement, pullbacks, recovery, and long-term compounding. S&P averaged 10.3% since 1928, rewards patience over timing. Wealth is framed as three engines: income, cash flow without selling; stability, volatility cushion; growth, inflation beating expansion. ETFs are celebrated as the ideal tool: instant diversification, low costs, or 0.2% average expense, automation, rebalancing, tax efficiency, and predictable returns from yield, dividend growth, and price appreciation. A four-lens ETF evaluation system is introduced: quality, solid earnings, balance sheets, growth, revenue, profit trends, stability, performance in downturns, income, reliable growing dividends. Common beginner mistakes are dissected: hype chasing, panic selling dips, lack of strategy, overconcentration, emotional trading, ignoring taxes, dividends, often costing 3.5% annual returns. The three portfolios, equal weighted for simplicity. 1. Income portfolio prioritizes income plus stability engines, ideal for those seeking predictable cash flow, e.g., semi-retirees covering expenses. ETFs, JEPI, covered call high yield, short 8.1% yield. SCHD, dividend aristocrats, short 3.7% yield. BND, broad bonds, short 3.8% yield. Averages, short 5.3% yield, 6.5% dividend growth, 3.1% appreciation, shock 8.4% total return. 10-day, 3,650 wire projection, reinvesting dividends. 10 years, 57K 20 years, 237K 30 bars years, 154 mer, 48% from compounded dividends. Year 30 monthly income, $10,500, no shares sold. Strengths, lower volatility, reliable payouts even in flat sideways markets. Tax notes, best in tax-sheltered accounts. 2. Balanced portfolio, harmonizes all three engines. For mid-career investors wanting meaningful growth without extreme swings, global diversification included ETFs, SCHD, Foundation, VGT, Tech Innovation, Massive Appreciation, INTF, International Factors. Averages Dividend 2.3% yield, 13.3% dividend growth, 11.5% appreciation, on 13.8% total. 10-day projection, 010 WERS, 71K 20 Guadant WERS, 346K 30 Guadant WERS, 148 man, year 30 monthly income, $4,100, outperforms income portfolio by 429K over 30 years while maintaining solid cash flow and resilience. 3. Growth portfolio, maxes the growth engine. For long horizon investors, 20+ years, tolerant of volatility, aiming for millionaire multi-millionaire status. ETFs, VGT, Tech Core, QQQ, NASDAQ 100 leaders, IWF, Broad Russell 1000 growth. Averages, 0.4% yield, 7.2% dividend growth, 18.5% appreciation, 18.9% total. 10-day projection, 010 Bible years, 89K 20 years, 575K 30 years, 322, 98% from appreciation. Outperforms balanced by 173 matters and income by 216 manners over 30 years. Low income intentional, focus is compounding into a massive nest egg, safe 4% withdrawal, or high monthly spend later. Comparisons, risks, and practical advice. Income, safest, lowest vol, on 8%, best for cash needs. Balanced, sweet spot, captures most upside with moderated risk. Growth, highest reward, highest drawdowns, e.g., 40% in crashes, but fastest recovery. Rebalancing, annual or 5% threshold. Tax efficiency, Roth for growth, taxable for qualified dividends, and automation emphasized. 2025 tips. Dollar cost average amid highs. Inflation-adjusted real returns, still strong at. Closing. Shakten Nesrins. Investing. Success is simple, not easy. Pick one portfolio matching your timeline risk tolerance, automate contributions, reinvest dividends, stay patient through cycles. No perfect ETF exists, only the right strategy for your future. Teaser for related video on $5 day, 8K plus bar month income.